Hey everyone, and welcome back. Today, we're unlocking a powerful secret to creating a stream of passive income. We're talking about dividend investing for beginners. We're going to break down exactly what it is and how you can get started right from square one. So let's just start with the biggest question of all, right? How can you make your money start working for you? It's all about making that shift from actively working for your money to having your assets generate income all on their own. This, right here, is the core of financial freedom, and honestly, it's way more achievable than you might think. To really wrap our heads around this, let's use a simple analogy that I think makes this super clear. Imagine you're collecting rent, but instead of getting it from a tenant in a house, you're collecting it from a massive corporation. Let's see how that works. This chart just lays it all out, doesn't it? I mean, with real estate, you're the landlord. You're active, you're dealing with leaky faucets, all the upkeep, all the headaches just to collect that rent. But with dividend investing, well, your income comes straight from company profits. Your role is totally passive. You're a shareholder. And your asset? It's a piece of the company itself. You get that regular rent check, but with none of the management hassles. Okay, so the concept makes sense. It's like being a landlord without the headaches. But how does it actually work? How does that money travel from a company's vault right into your pocket? Let's break down the actual mechanics. It's a really simple three-step process. First, a company does well. They have a great quarter. They earn a profit. Simple enough. Second, the company's board of directors looks at that profit and decides, hey, let's share some of this success with our owners. And who are the owners? Well, that's you. As a shareholder, you are a part owner of that company. So third, they pay out that portion of the profit, that's the dividend, and it gets deposited right into your brokerage account. It is literally your slice of the company's success. All right, so you're getting excited, you're ready to start. But how do you find the right companies? You can't just pick one at random. You need a toolkit. So we're going to focus on 3 absolutely essential metrics that will help you size up any dividend stock you find. First up in the toolkit is yield. This is just the annual dividend payment divided by the stock's price, and it gives you a percentage return. But, and this is a big but, a word of caution, the highest yield is not always the best. In fact, a crazy high yield can be a red flag, maybe because the stock price has tanked, which could signal problems. What you're really looking for is a healthy, sustainable yield. And that brings us perfectly to our second tool for checking that sustainability, the payout ratio. This tells you exactly what percentage of a company's earnings is being paid out to you, the shareholder, as dividends. Is it 20%, 50%, 90%? This one little number reveals so much about a company's financial health and its priorities. And this chart right here just illustrates a beautiful, healthy balance. In this example, 45% of the company's earnings are paid out to shareholders. That's your dividend check. But look at the other 55%. That's kept by the company to reinvest in new projects, R&D, and future growth. A lower payout ratio, usually under 60%, is a fantastic sign that the dividend is safe and that the company is still fueling its own engine for tomorrow. Our final and maybe most important tool is growth history. This isn't just about a company that pays a dividend. No, this is about finding a company with a long, proven track record of increasing that dividend payment year after year after year. That kind of consistency is just a massive signal of a stable, well-run, and seriously successful business. And there's actually a special name for the absolute best of the best in this category. Companies with a really long history, we're talking 25 years or more, of consistently raising their dividends are known as dividend aristocrats. It's a title they've earned through sheer reliability, and it's a great term to keep in mind when you're doing your own research. And here's what that growth actually looks like. It might start at $1 per share. The next year, it's $1.05, then $1.12. Now, it might not seem like a huge leap at first, but imagine this compounding over 10, 15, 20 years. That is how you build a truly powerful and constantly growing stream of income. So we've covered the analogy, we've gone through the mechanics, and we've opened up the investor's toolkit. Now, let's zoom back out and connect all these dots to the big picture, building your own financial freedom. So why does all of this really matter for you? Because when you carefully build a portfolio of these strong, reliable companies, you are literally creating your own engine for passive income. It's an income stream that can grow over time, helping you beat inflation and steadily build your long-term wealth. This is a real, tangible path towards financial freedom. The goal, when you get right down to it, is to use these tools and this strategy to build something incredible for yourself. an income stream that keeps working for you 24/7, whether you're on vacation, sleeping, or finally pursuing that passion project. You're building an income stream that never, ever clocks out.